Imagine a world where entire nations are trapped in invisible chains. A chain not made of iron, but of numbers on a ledger. You work, you pay taxes, your government borrows, and somehow the richer the banks get, the poorer the people become. It sounds like a conspiracy theory, but the truth is far more unsettling. For centuries, a quiet system has allowed banks to profit endlessly, even as countries teeter on the brink of collapse. How does this happen? Who really wins when nations drown in debt? And why does the system never seem to break, even when it should? By the end of this video, you'll see the invisible mechanisms that make debt the most profitable product in human history, and the chilling pattern that repeats itself again and again. To understand this, we need to go back over 400 years. The modern banking system didn't emerge overnight. It evolved alongside global trade, empire building, and the birth of paper money. In the early 17th century, banks like the Dutch East India Company and England's Bank of England began lending money not just to merchants, but to entire governments. Why? Because war and expansion are expensive, and rulers rarely had the cash on hand. Here's the first twist. The banks weren't just lending money, they were creating it. Through a process called fractional reserve banking, they could issue far more currency than they actually held in gold. Every loan was, in effect, new money. This system gave governments a lifeline, but it also tied them to a silent, invisible creditor, the bank itself. Key figures like Nathan Mayer Rothschild in the 18th century were among the first to exploit this system, quietly lending to countries during war after war. The more a nation borrowed, the more dependent it became, and the more profit flowed back to these financial powerhouses. By the 19th century, this system had exploded globally. Governments borrowed to build railways, finance wars, and fund empires. On the surface, it looked like prosperity. But behind the scenes, the pattern was clear. Debt grows faster than economies, and interest payments become a massive hidden tax on the population. Consider the US in the early 20th century. The Federal Reserve, created in 1913, was meant to stabilize the banking system. But it also gave banks unprecedented control over the nation's money supply. Wars, depressions, and infrastructure projects all funneled through this system, ensuring banks earned enormous profits no matter the economic outcome. Even during crises, like the Great Depression, banks found ways to profit. Foreclosures, restructuring, and government bailouts created a safety net that protected lenders, while ordinary citizens bore the brunt of collapse. But history has shown that even the most robust system has cracks. Nations that borrowed recklessly eventually reach a breaking point. Take Greece in the 2000s. Years of government overspending, coupled with hidden debt, pushed the country to the edge. Banks knew exactly what they were doing, lending vast sums at interest rates structured to maximize their returns while transferring risk to governments and citizens. When the debt crisis hit, Greece collapsed, but the banks remained largely untouched, often profiting from rescue packages and austerity measures. The same pattern repeats everywhere. Argentina, Puerto Rico, even parts of Africa, each story is eerily similar. Governments collapse under debt, citizens suffer, but banks quietly walk away richer than ever. Why doesn't the system collapse entirely? Why do failed policies, bailouts, and debt forgiveness rarely stop the cycle? Because debt is designed to perpetuate itself. International organizations like the IMF and World Bank often step in to stabilize economies, but in doing so, they make countries even more dependent on lending institutions. Austerity measures, structural reforms, and conditional loans all transfer wealth upward, from citizens to banks. Even modern financial innovations like derivatives, credit default swaps, and sovereign debt restructuring are simply new tools to extract profit from failing systems. They don't solve the problem, they amplify it. Every fix reinforces the same chain that keeps nations under invisible control. Fast forward to today, global debt has surpassed $300 trillion. Countries like Japan, the US, and Italy carry debts larger than their GDP. Meanwhile, central banks continue to inject trillions in quantitative easing, keeping interest rates low and ensuring banks profit from every move. The most shocking part? The same cycle continues unnoticed. Ordinary citizens face stagnant wages, inflation, and tax burdens, while banks collect interest, sell derivatives, and speculate on government bonds. Every crisis, financial, pandemic, or geopolitical, becomes another opportunity for profit. Look at the COVID-19 bailout packages. Governments spent trillions to prop up economies, but a huge portion ended up in the hands of large financial institutions. Once again, the public bears the risk, the banks reap the reward. So what can we learn from this hidden system? Debt is not a neutral tool. It is engineered to benefit lenders first. Governments borrow, citizens pay, banks profit. Financial crises are not accidents. They are predictable outcomes of the system. History repeats itself with alarming regularity. Bailouts and reforms often protect banks, not people. The structures of power are designed to ensure banks survive, even when nations fail. The question isn't whether the system will fail again, it's when and how deeply citizens will feel it. Every new debt package, every financial innovation, and every central bank policy reinforces the same invisible chain. The real mystery is not why nations collapse, but why so few see the pattern. If you want to understand the hidden forces that control money, debt, and power in our world, subscribe now and hit the bell icon. The truth is out there, but only those who look closely will see it.